Good afternoon. We are separating you from two things. Drinks, for any of you that are thinking of going away early. But even more importantly than that, after we have finished our discussion, I will be announcing and introducing you to the winner of our first competition for the greatest idea for somebody between the age of 16 and 19 about changing the world. So if anybody goes out of here before then, you are not going to be let back into any other Chatham House events again. So, with that in mind, ahead of that, we're going to talk about, I hope, business with purpose. Better purpose of business is the life beyond profits, which encompasses all sorts of things. And I have three very good friends, all of whom I would say from different angles are genuine pioneers and early thinkers about lots of this stuff. And I'm delighted and honoured that they were prepared to give up some time to come and share their wisdom with us and to provoke all of you into helping make business think better and the world a better place. And I'm not going to go through their histories because that would take up too much time, and I'm already jabbering on as I only can do. But we have David Blood, Michelle Giddens, and Jane Ann Gadget, and I'm sure you all know who they are. So, to start us off, and you've only got 3 minutes, and unlike others I gather earlier today, I'm going to be tough with the 3 minutes. Within this space, David, what is the big thing you want to tell everybody is crucial? I mean, lots of things are crucial about it, but what is it you want to tell everybody?
Well, good afternoon, everyone. Thank you, Jim. I want to, I think, make 3 points to start, if I may. The first is, and I know that part of this was discussed this morning, but we fundamentally believe that while government and civil society will be critical to address the global sustainability challenges that the world faces, business and capital markets and investment has to be part of the solution. In fact, maybe the driving part of the solution. The second point is there's a big difference between shareholder capitalism and stakeholder capitalism. Best practice actually is stakeholder capitalism. Over the long term, that will be a superior economic model. And lastly, the challenges that we face, whether they be climate change, environmental challenges, inequality, development challenges, in fact, to meet either the Paris Accord or the sustainability, the 2030 sustainability goals, we will have to make dramatic change over the course of the next 5 to 7 years. At our current pace, we are not going to become even close to achieving these objectives. And so all of us, whether it be government, civil society, and very importantly business, will need to move very quickly, very substantially, not in an incremental way, in a transformational way to address these challenges. So time is of the essence.
Thank you, David. And let me just say, and I'll perhaps come back to this, as somebody that has invested in David's first fund, Generation's first fund, what is it?
15 years.
15 years ago. He thinks like you've just heard a snippet of, and has outperformed conventional ways of investing. So this, we'll come back to this perhaps, and others perhaps bring into your comments. There's often this notion out there, which actually arguably our current Chancellor has added to that as it relates to climate change, that you can't do good stuff and still get good growth and good returns, but this guy lives and breathes this life and has done. Jane, you're next.
Thank you very much, Jim, and hi everyone. I mean, I disagree with our current Chancellor then, because I think you can only get good and sustainable returns if you do good stuff. And so I'm Jane Ann Gadget. I was the CEO of Virgin Money until it was acquired by the Clydesdale Bank last October. And as part of that deal, one of the things that I turned my mind to was when a public company acquires another public company, obviously there are all sorts of regulations to follow through and all sorts of fiduciary duties that the non-executive directors in particular have to follow. And I was very concerned about how we did the deal well and did the right thing. And I decided to write to a few people around the city to give me a little bit of advice, all of whom came back very helpfully. But the most helpful input, interestingly, came from Justin Welby.
Wow.
And I dropped him a note because we at Virgin Money had done a bit of work with savings products in Church of England schools, which is how I knew him. And I said to him, I've got this conundrum. How do I think about doing the right deal by my shareholders? This is why I like your point about stakeholder management. And also do the right thing for our communities and our staff and bank branches, etc. And he came back to me, and I know he's happy for me to share this. And he said, Joanne, there are a lot of people that think that the business of business is business. But people like you and I know that the business of business should be human flourishing. And it's only if we can achieve that we can achieve a sustainable future. And as a consequence, as part of our deal, it's funny, Goldman were our bankers, Jim. And
who are they?
Yes, Jim's one of Jim's previous companies, of course. And Goldman did say to me they'd never had the Archbishop.
6 years since I've left
a deal before.
I can hardly remember how to pronounce it.
But it's interesting because I think, for me, the purpose of a business is the thing that gets me out of bed in the morning. People I don't believe get out of bed in order to make, well, some do, but to process an application form, answer the telephone, or just make money. I think people genuinely most people want to make a difference. And at Virgin Money, we tried to make a difference by having a corporate ambition, which was to make everyone better off. And we sold the business that we created from nothing for $2 billion in the end. And if I look at what made Virgin Money valuable, it actually wasn't the fact that our products were any better than any other bank. They were good but not better. The processes were good but not better. We loved our customers, good but not better perhaps than all. But I think the thing that made the difference was the purpose that meant that we could unite our customers and our colleagues in trying to do something good together. So I'm a passionate believer that sustainable profit is only achieved through clear goals and a shared purpose and a good business in society.
Before I lose the thought on that, I'm just going to push you again. So could you identify some of your investors that were indeed giving you that value and their investment because of their perception of your purpose?
I think that, I don't know, am I allowed to say specifically an investor? I don't know if I should or not, but
Your call.
One of the very large corporate investors, actually Aberdeen Standard, since you've said this, was very significantly invested in us. And I think, clearly they're focused on our performance, but they're also focused on the purpose, on the brand, what it meant, the fact that culture in banking was important, and they could see that actually this was something that was somewhat different and therefore gave them an additional purpose to invest behind, if you like. Not an alternative one, but I think it meant that the whole story was more holistic.
Thank you for now. Michelle, I think of you as being some kind of rock star of getting stuck into run-down, decaying urban London. What's itching on your mind to get over to everybody?
Do you want me to break into song next?
Actually, somebody
Sing
said
the
we look
impact
like a...
investing anthem.
There you go, yeah, why not?
Well, thank you. And I want to thank Chatham House for inviting me to be here. And if I may, also maybe give a little bit of friendly critique, because I'm just sitting here wondering whether our panel is balanced enough in the sense that we are all, I think, in the business of making investments or running businesses for whom purpose is at the heart of what we do, and we all definitely believe that that is the way of business for the future. So let's hope perhaps there's some in the audience that might take a different view so that we can get a debate going, because the fact is, and the problem is, that although there are increasing ranks of companies and financial institutions that are joining us, and David, you and I both set up our firms back in 15 years ago, yours 17 years ago, Bridges, and when we set that up, certainly I know I went fundraising for Bridges, and I was told, we were mentioning it earlier, weren't we? I was told really kindly by a lot of men from the city that we had got it wrong, that if we cared about having a positive impact on society, then we needed to be a charity. And then if we cared about making returns, then we needed to forget about making an impact on society. And so I want to say a bit like David, 3 key things from my experience of seeing the change since those conversations back in 2002. The first is that I really do think we're in the midst of a paradigm shift. I think that in this century, we are needing to answer the question, how does business better serve society? And I think it is becoming a norm for businesses to seek a sense of profit. And we're seeing, I think, the end of shareholder primacy. So stakeholders matter and not just shareholders. So a paradigm shift, a change in the contract, I think, between companies and society, but still not nearly enough. Secondly, in the world of investing, we are really seeing a change. So where there was black and white, there was philanthropy and there was serious investment. Now there is a rainbow of different options for investors that sits between those two. Everything from invest for maximum risk-adjusted return, which is, I think, going out of fashion as long as into invest, but remove risks, environmental, social, and governance risks, what you might call responsible investing, into actually the best businesses and the best investments are the ones that know that they need to be sustainable and inclusive to succeed in the future. And then through further into the world that I inhabit, where we say, actually, you can use investment to try to solve challenges. The world of impact investing, where you literally look at the lenses of challenge, and then you try to find investable solutions to them. And then all the way into the kind of impact investing, where in order to solve challenges, really difficult, tough challenges, you need to partner up with governments. So for example, perhaps we can talk later about the model of a social impact bond, which is a great example of where the financial sector, the non-profit sector, and the government sector partner up. So change is coming in the world of investment, and just in the last couple of years, pioneers like ourselves have suddenly been joined by Goldman Sachs with its private wealth impact investing arm, by BlackRock and Larry Fink's big remarks on the subject, by big private equity firms like TPG with their Rise Fund and KKR. So the mainstream finance is suddenly coming into impact investing. So the paradigm for business and society is changing. The investment community is moving, but it is not fast enough. And then finally, my last thought would be, I see in the future a simple addition to all business calculations. So in addition to risk and return, will need to be an evaluation of impact. And there's a lot behind that we can come to in terms of what would be needed for that to be a part of every business and investment decision. But I personally think that is and certainly needs to be the future.
So hopefully you can feel already why I was so excited when these 3 accepted my invitation to be here. And to put it in context, I'm sure it's been touched on today. As chair of Chatham House, I am extremely enthusiastic about us helping embed this culture into the world that we are existing in and hopefully going to help improve. But before I come back to you all, actually let me immediately go take Michelle's challenge to you guys in the audience. Is there anybody sitting here that think these guys are for the birds and actually they're talking nonsense? Anybody want to say something?
Someone raised a pen.
There's a couple of hands going up. Please say who you are. We're going to lock the doors so you can't get out when you've said what you've said. Okay.
On the Chatham House Council. We've just been at a breakout session upstairs in which it was said that a large amount of Russian dirty money is here in London. I heard separately from somebody I had breakfast with last week that 52% of Latvian dirty money is in London. So how does that square with what Michelle has just been saying?
Come back to that one. I think there was another hand here. Please identify.
Nancy Wilson with Relief International. I appreciated that you added the caveat that there's a wide spectrum, because I think in many fragile settings, we've got market failures, and no amount of investing in return is going to actually help those economies get themselves up and running. And I think there was a a bit of a blip a few years ago where everyone got very excited about social enterprise, that was going to be the solution for absolutely everything, but it's not. I think we've learned a lot about when we can use cash in markets in development and humanitarian settings, but there are just places that still need support, and I think we've just got to make sure that impact investing keeps its eye on that part too and doesn't try and say we can solve all the problems.
So let me use both those questions to come back to you all and separate them, or you can answer both if you like. But I was going to ask and part this thought that, do you guys, being such sort of pioneers in this, is impact investing a bit of a joke phrase, or should we outlaw CSR as sort of something that sort of just because it allows companies to play and not be serious? Think of those two things. But actually, Jane-Ann, let me take this, given your soon-to-be starting role as sitting on the Bank of England court, what do you think about this accusation that London's still this haven for horrible money?
I don't have any experience of that, and so I can't answer that question directly. But what both of these questions were making me think was, I think we should be more precise around what we each mean by business purpose. So, from my perspective, of course we shouldn't be dealing with dirty money. There are businesses that do. They need to be weeded out by the regulator, and people need to be held properly to account for it. I think we as a society and as a city haven't held people properly to account for all sorts of problems over the past, and I absolutely think that should be happening going forwards. I think in terms of your point on where investment, social impact investment, for example, could be helpful to economies that need it, my comments aren't actually addressed to that point. What I'm saying is, I think it is beholden on us as a society, post-Brexit, as a leading capitalist city and nation, if you like, to demand that people do good business. And that good business means running one's own business well, looking after your people, looking after your shareholders, doing the right thing in society, making good profit, not bad profit, certainly not using bad money in order to drive your growth. But I don't think that for all businesses it will extend to either ends of that spectrum, if you like. If we can help in particular ways, then I think there are investment funds that should do that. If we find that there's dirty money anywhere, then quite clearly we should walk well away from it. I mean, a small story from me, as I was setting up Virgin Money many years ago, a senior Russian man came to see me. He'd been sent to see me by Richard Branson, actually. And we were looking for money to set up the bank, and this guy was due to see me at 9 o'clock in the morning, and he turned up raging drunk at 10:30 and was abusive to was the receptionist in the business, as it turns out. And we sent him away. And however much money he might have brought and invested in our business, that was never going to be good enough for us. And it's a small point, but I think we have to make sure that conduct is right in all respects.
David, is this something, the dirty money issue, something that I guess as long as you and I have known each other and talked about hundreds of things, I don't remember us chatting. Is it something you got a view on?
Well, obviously it's bad, but it's, to be honest, it's not something that I have dealt much with. It's not the capital markets that I operate in, that we operate in, is not sourced by dirty money for the most part. Right. This is an institutional. It's a $90 trillion marketplace. Maybe there's some less than honorable folks there, but that's not an issue for us. But the other question I wanted to answer that you made is, what do people think about impact investing? And I think, frankly, the big challenge that we have when we talk about business with purpose, we talk about sustainability, we talk about responsibility, we talk about impact, is that it means something to everybody slightly differently. And so maybe, and particularly actually the concept of impact investing. And so I think our perspective would be all business and all investing has impact. You can't separate it. You can't say business doesn't have impact, or sometimes it does, or capital sometimes has impact, sometimes it doesn't. It all has impact. The question is, do you intend to have the impact? Are you measuring the impact? And are you prepared to take higher risk or lower return for that impact? But all business, all capital has impact, and it's important that we recognize that. And I think the second fundamental point to add to that is, and you were getting on it a minute ago, ultimately, we think best practice business is long-term, best practice investing is long-term, and to ultimately generate the highest return for, and return includes impact for stakeholders, is to be more holistic and inclusive in understanding what are the impacts of your business or your capital. And we think is actually superior business. It's a superior business model if you're long-term and you're inclusive in all your stakeholders. It will ultimately result in a more robust and strong business model.
And in that regard, let's keep with the theme in terms of CSR, David, and I'll come to Michelle in a sec.
I think
is that like past its sell-by date?
I think CSR is philanthropy. I am a big fan of philanthropy. I love philanthropy, but CSR is philanthropy. Best practice business is much more holistic. If you're running a financial institution, culture, values, how you treat people, how you operate in your community, that is your license to operate. It is just smart business.
Michelle, I see you nodding. So, what do you think about this stuff?
Where to start? The first thing is that David just gave a magnificent description of a piece of work that Bridges has been facilitating called the Impact Management Project, because you asked about the terms here, and they are incredibly confusing and divisive, and people vehemently think they're agreeing when they talk about impact investment. They actually mean something very different, or vehemently think they're disagreeing.
Let me throw in here, and I'll come back to the audience to see some hands up again. I mean, is there something necessarily wrong that we can't put in a nice little box what impacts investing? I mean, why is that a problem?
What the Impact Management Project has done, and it goes to what I was saying about, if I'm right in boldly saying that over time, maybe even the Russians that are not criminals will be looking at impact as part of their investment. They may not be the early adopters, but if I'm saying everybody is going to eventually adopt it, then you need sort of really clear principles. You need almost a system of accounting for impact, which is similar perhaps to financial return, perhaps, I think, a little bit more to risk. And what the Impact Management Project has been doing has just been starting to build a consensus with about 2,000 investment organizations around the world to see if we can start agreeing, first of all, on terminology. And so the Impact Management Project has made it really, really simple. They've said, yeah, impact investing is a terrific thing. Impact investing is one part of a whole spectrum of activities, but the big story is what David said. Every single investment that anyone makes has an impact on society, and the only choice is, if you are the one making that decision, are you going to identify the most material impacts? Are you going to reduce the negative? And are you going to promote the positive? And that's what we now call impact management. The Impact Management Project says, forget all this language of impact, sustainable, responsible, ethical, and just say there's an ABC. So as investors, some of you, as far as you can go as investors, some of us is to say, I'm going to avoid harm. I'm going to identify the harm in my investments, and I'm going to avoid it. Others can go further. David is, I think, a prime example of, I am going to, that's A, avoid harm. I'm going to B, invest in businesses that benefit all stakeholders. So that's what the B means. And then others, like myself, will go further and say, I do Bs as well, by the way, but I'll also do Cs, which is where I'm deliberately trying to contribute to solutions to challenges. So a simple A, B, C is one way through the lexicon. Just very quickly, I thank you for your comments, and I have the pleasure of also being on the board of CDC, the UK's Development Finance Institution, and so we're incredibly familiar through that, the various challenges in emerging markets and the different types of capital and the ideas of blended capital, all of which are very important. I do think it's important, and I'm sure I don't differ actually from my colleagues here, it's very important not to say, guess what? You can invest in stuff and you will make the best money and change the world for the better, and everything's going to be sorted that way. There are a lot of investments like that. There are an increasing number of incredibly exciting investments like that, but there are also very difficult issues that require blended finance or a higher risk or a lower return than the market would tolerate. So all of these things, though, just to finish, although to the dirty money question, I mean, I think what that's really getting at is, although we're very passionate and it feels as if this room primarily agrees with us, we are still a tiny minority.
Right.
So 70 trillion of the world's assets have signed up to the PRI, but that is a very, relatively low bar. Impact investing is an absolutely tiny portion of the money invested in the world.
I want to come back to explore ways of enforcing it, but Jane, Anna, you want to...
I wanted to come to your point, Jim, about is CSR dead, and just to say that I think the financial crisis, by the way, is a line we should note here. You're talking about starting off in 2002, and it's much better now. I think the financial crisis made that clear.
Yeah.
Now, I worked for RBS just before the financial crisis. I left in 2006. And, in RBS, Fred Goodwin absolutely wanted everything to be as good as it could possibly be, genuinely. And he led an absolutely exceptionally strong CSR program. And then on one particular occasion, I remember, we've all been involved with disaster recovery programs. I was leading what was called the Silver Team for the disaster recovery program at RBS. And the role play that we were in was, RBS was involved with the Bank of China at this particular time. And the role play was that there was a big attack on the internet, the RBS internet at that time, from China. And the reason it turned out was that it was to do with human rights abuses. People in the team were fascinated about should we not be saying something, given that we're in China, about these abuses. And Fred, I remember saying, it is nothing to do with us. The only thing we are ever responsible for and interested in here is shareholder value. And it caused a really interesting cultural discussion in RBS, which was, is that true or not? So here was a business, if you like, that was saying we're only about shareholder value despite, this is a pretend thing, abuses, but investing a lot of money in CSR. Yeah. And as a culture, the organisation could not find a way to justify those two differences. And I suspect it was those sort of tensions that led us to some of the places that we're in.
Audience, I mischievously interpret what Jane Ann's saying there, that if you run your business with a CSR department, you could end up like Fred Goodwin. I think I saw Kayo wanted to put his hand up for a quick. There's loads here, and there must be some people over there, I'm sure, but Kayo, please tell everybody who you are.
Yeah, Kayo Kochweser, European Climate Foundation, formerly Deputy Finance Minister, Germany. What you have demonstrated very powerfully, there's huge opportunity now that's getting traction, is on opportunity side. What about the risk side? And I mean specifically carbon risk disclosure and corporate balance sheets. What Carney started, the Bloomberg Task Force elaborated, you were involved, and is now getting traction. How does that, in your view, relate to what you are doing?
Okay.
How much traction does it have? And specifically, once we have learned how to do that, testing business plans about dynamic future climate scenarios, physical or politically induced, would you move from voluntary disclosure to mandatory disclosure, for example, in Europe and beyond?
So remember that one, guys. I just want to try and take a couple of others. I don't see anybody over the... Oh, there is over the back there. There's a hand up from somebody, a lady over there.
Hi, Zania Wickett.
Oh, Zenia, I'm going blind as a bat. I can't even see.
That's okay. You asked for somebody to almost play devil's advocate.
Yes.
And give the other opinion. So let me just put one out there, which is, what about the fact you're talking about having impact, but the corporate sector has no legitimacy. You're not voted in, so you've got no kind of legitimacy that a government has, or at least a democratic government has, by being voted in or voted out. So how do you deal with the fact that actually you may hold interests that other people don't hold and don't think are the right ones to move forward? And then just to pick up David's point about thinking long term, you also have the problem, much like democratic governments, there's actually a short-term need to meet your shareholders' demands over the short term. So how do you actually think long-term while you're being pressured sometimes to think short-term as well? And that, again, creates a difference.
Okay. Actually, I'll come back again in a minute, but there's two big questions there. So both of them, David, starting with you again, particularly with Kaya's very specific thing about getting real on climate change stuff.
Well, I guess full disclosure, as Kyle knows, I'm also part of the task force on climate change disclosure that Governor Carney and Mayor Bloomberg have led. So I will have a bias to disclose to everyone. But I think a couple of things to say. I think it is now very clear that carbon risk is a relevant risk in financial markets. And there are very few investors, there's some, but there are very few investors who aren't some way, shape, or form beginning to think about their carbon risk. And those who aren't thinking about carbon risk, frankly, are not fulfilling their fiduciary duty. So the case is becoming quite strong. The question is whether we have adequate disclosure at this point, and the task force is voluntary. We've had, in fact, we just released our third report last week, and we've made significant progress. But we've not made nearly as much progress as we should do. Part of it is because we need to refine some of our suggestions around scenario guidance, and there's some challenges of that. But part of it is that we've not, I think, seen the take-up from companies as we would like, because it's hard. And that's the point, is actually it's hard to come up with what your real risks are, but that's actually why it's relevant. I think what you will see, and certainly in Europe, and indeed I think globally, I think these recommendations will slowly but surely not be voluntary, they'll be mandatory, and they should be mandatory.
You want to deal with Xenia's interesting challenge as well, David?
It is interesting. So I guess I would say a couple of things is, first, the businesses do have a constituency. It's their customers, and they're the people who are purchasing their products, and if they don't or services, and if people don't like what they're doing, ultimately people will stop purchasing their products, which is the point I really want to make. I think license to operate is a really critical issue for business and for finance. And for all of us who are in business or finance, we should make no mistake about this. And I'll just talk about finance, I won't talk about business. I think we're very close to losing our license to operate. Most people don't know the difference between a hedge fund manager, a private equity manager, an investment manager, a pension fund manager, a banker, et cetera. We're all lumped into one not so nice bucket. And so therefore, we better figure out how to use finance for good, how to make it a much more robust and inclusive type of structure and system. And it can be done, and it can be done over a long period of time, or resulting in a long orientation that is ultimately a stronger, better, fairer economy.
Joanna?
Ooh, well,
follow that.
So I'll try and follow that. So first of all, on the climate change point, I have separately and obviously very differently led a program on diversity in the workplace where we're encouraging people to report gender pay gap, etc. I am absolutely coming to the conclusion it needs to be mandatory and legislated.
Wow.
And I think, climate change is even more important in my view, because what's the point in sitting here if in 20 years' time we're all dead? So I think it's very, very important that we legislate. In terms of the legitimacy of business, I think that's a really interesting point. I mean, in these days of social media, there are all sorts of people that, in my view, don't necessarily have a legitimate voice that are able to express it. And I think that, for me, as business leaders and business people, we have, there is so much invested in us, and we have so much that we owe to society, that to share some of those views, that's not to impose views, and to try and do good, must surely be the right thing. I was at the Time CEO conference on Tuesday, and John Neal, not Jim O'Neill, John Neal, who has been the CEO of Unipart for astonishingly, I think he said 36 years or 32 years or something, amazing. John Neal. And he's the longest serving public company CEO, I think.
Wow.
And he was asked this particular question, how have you managed to get from quarterly reporting periods and still be known for driving a business with purpose? And he said, which I think is right, you have to, as a business leader, know what's the right thing and stick to it regardless. and your shareholders will either invest in you or they'll kick you out. And he's been able to demonstrate that doing the right thing sustainably for that period of time has grown shareholder value too. So I think he's a good case study to look at.
Michelle?
Yeah, so maybe starting with that, building on that, I suppose in terms of short-term horizons, I just reflect when I fortunately invest in private markets, so we have long-term horizons, but we did that quite deliberately because in 2002, when there was the rise of responsible investment and sort of not investing in tobacco and not investing in South Africa, that sort of ethical investment was focused on quoted companies. And that always seemed very strange to me because actually if you want to be able to make change, then you've got very little control over companies that are on the stock market, and you are subject to some of these drivers. So in a way, it's a kind of a harder place to do impact investing than when you're investing directly into a company, directly into a property, and really very involved. Secondly, in terms of the license to operate and your point about legitimacy, I don't think, I hope that none of us sitting here would be saying that business, we're not, that business can just sort of make its own mind up about how to solve the problems of the world and is just free to do that, and this is our idea for how capitalism better serves society. There's no doubt that business needs to be balanced by the role of civil society and the role of government, and that doesn't go away just because we're saying that business investment is suddenly waking up and realizing that they're not going to just do the minimum that those constraints require of them, that they're actually going to go further. And then another point that hasn't really come up here is just perhaps the role of technology and transparency in all of that, because you talk very eloquently about license to trade. Well, license to trade is a lot more perilous these days because of transparency and technology. And I got one little example here that I sometimes share, which is the Rana Plaza disaster in Bangladesh, the collapse of some of the garment manufacturers. And just a little story was, in April 2013 it happened, and well over 1,000 people died. That's the 24th of April. The 24th of April, same day, Benetton put out a disclosure saying we didn't have any production in these plants. And by the 27th of April of that same year, there was a photograph going viral online of a shirt with a Benetton label in it in the rubble of that plant. And so by the 29th of April, Benetton needed to respond. And in this case, perhaps it was a little unfortunate because they said it was only one round. They didn't really normally work with that supply. However, the level, I just make that point because of the level of transparency. And I do think that that is one of the reasons that we are seeing a change in business practices, is that civil society, and in fact even customers, can hold companies to account because of the transparency that they get of their behavior these days.
So I'm going to push you guys a bit more on something that I've become heavily focused on as a result of the antibiotic resistance review I led. I'll start with you, Jane, because you said some pretty strong things about legislating on some of this stuff. Would you go as far as to limit the ability of publicly quoted companies to buy back their own shares if they didn't fulfill some of these, let's say specifically the equality agenda? Would you if you were Prime Minister tomorrow?
Let's face it, it's a big field.
It's a big field. I'm not sure. In theory, it's closed, but for good entrance,
I mean, so generally, where I've got to, Jim, is that I would prefer more higher level legislation. So I don't know that I'd go specifically down that route. You know, I'm not into regulating everything and legislating for everything. But I've realized over the years that I'm actually a naive person, and I naturally expect the best of everybody, and I get smacked in the face very often as a consequence. And I do think that some of these things that we ask people to do because we think people have good intentions or because we think they're the right thing to do, to start with, when there's a media campaign or a head of steam going, organisations tend to follow what they think is the right thing in the short term, and then something else comes and hits, and it suddenly goes down the agenda again. And either because it doesn't make money, or it's not the flavour of the month, or simply because there's other things to do. And in my experience, it's the things, particularly at board level, where non-executive directors are really clear on what their fiduciary duties are. That's what they focus on when the proverbial hits the fan. And I think that, I hadn't heard this expression before, and I clearly should have done, David, to make it really clear that they're held to account for the breadth of stakeholders, not just the narrow interests of shareholders, is absolutely essential, and I think that will have to be legislated.
So Dave, in the same, I don't know if maybe some of you don't perhaps even realise what I mean as a share buyback. This is a company's ability to buy back in the market its own shares. And I think I'm right in saying that in the accumulated period since the crisis, companies are collectively the single biggest buyers of publicly quoted equities in the market, which strikes me as sort of nuts in this broad context. But what do you think about it all?
I think, well, first of all, I do think share buybacks as a rule are not often a good use of capital, and to lower taxes to facilitate share buybacks, I think, is a really, really bad idea. That might seem more political than I mean it to, but it's not clear what the economic reason for it is. So in the last 40 years, the financial markets and business have become much more laissez-faire. And we've seen significant deregulation. When I started in finance in 1981, Glass-Steagall still existed. That was where a separation of banks in America with investment banks. It was a different sort of financial market. And then we have, over time, deregulated. And there's been some good things, but there's been some very not so good things that have happened, most recently in the global financial crisis, but we were leading up to that anyway. There is no reason to say that the financial markets need to operate the way they have in the last 40 years, the next 40 years. And in fact, I don't think that will be the case. I think we'll fundamentally have a different set of rules, and we should have a different set of rules. Now, exactly how we legislate and think about the regulations, that you'll be one to have to think that through, and there'll be others who are on central bank councils around the world who have to think about that. By the way, I think technology will be regulated differently. But it's probably the best thing for us, because the current situation, the current way markets are operating are categorically not right. They're categorically not fair, and they're resulting in distortions and failures that are simply not going to be sustainable for us as citizens.
Michelle? Anything to add?
I really don't think I have on
okay,
that one.
let's go. There was lots
that.
of hands up still. There's a lady here in the front. Mike down here at the front, please. And then I'll come to Heidi and this gentleman in the purple shirt.
Hi, my name is Kimberly Geyer. I'm a former banker, now a strategic philanthropist, and I wanted to address the market issue, the pipeline issue is what I see. So personally, I've donated my skill set, and I have a community of people who do this, bankers and lawyers, to try to facilitate pipeline building in this space. And I think that, going to your CSR question, having done everything from watching philanthropists paint the same fence over and over in their local child care center, we need bankers to come in and help structure the solutions. And so we need a safe space to tackle these problems. And I personally have worked on a couple of transactions where if the bankers had not come in, the transactions would not have got up. And there's many, many more where there's so much pipeline building that's going on. Somebody has to invest in that. And when you're in an investment bank, you have capacity to run people who build pipeline, build products. This market does not have that. I've had people come to me asking if I can help them find working capital loans so they can keep the pipeline going, to work on green shipping and other fantastic ideas, but we're not investing in the pipeline builders, and this is where CSR actually can play a role, but you need to create a safe space for it, conflict of interest, et cetera.
Okay, thank you. Heidi, please tell everybody who you are.
Heidi Baumann. I'm a member of the Chatham House Council, and I read yesterday the news about the second division fund, another 100 billion, again 45 billion to come from Saudi Arabia, like with the first division fund, which owns, for example, Britain's biggest tech company, the Cambridge-based manufacturer of chips, ARM. which is in a lot of smartphones, and it owns a big share.
Would you guys take money from the Vision Fund? I
Well,
think
would
is the
you take
question.
money from the Vision Fund, and should we worry about a second Vision
Okay.
Fund?
This gentleman here.
Yeah, hi, my name is Shajoy. I'm from the London School of Economics. Since impact measurement is a core aspect of impact investment, do you think that investments are biased and in favor of those measures which can be easily measured and and are less costly? There tends to be a bias in favor of those
Very
measures.
interesting question. Maybe one more from over here somewhere. There's a hand right up at the back.
Hi, Anna Wallace, PwC. Jim, you said that people don't know the difference between hedge fund, private equity, etc., which I think
David said that.
Sorry, David said that, which I think is true.
Okay, and then Jim probably said it if it was.
I wrote it down for him.
One thing that I heard a lot from people in finance after the referendum was, we need to go and educate the country about what financial services does, which I found incredibly irritating, frankly. But my question to the panel is, so how do business engage with the public to answer that point around a mandate without being condescending, patronising, and I guess being sort of engaging in an open basis and potentially with our ears open too?
All three very interesting questions. Shall we draw the blinds and spend another few hours in here trying to deal with those guys? David.
Well, I'll start with your question. Actually, in this country, there are a number of organizations that have been developed relatively recently to try to address that. There's the Big Society Capital that has the unclaimed assets that is meant to be facilitating that. There's a group called Social Finance that I also helped to found both in the US and here in the UK that was actually meant to be exactly that type of organization. And the reason why the social finance has evolved some is that a lot of these organizations struggle to actually take capital. And so we've had to develop a different sort of tool set to try to help them along the way. But you're quite right that building that pipeline, and when I say that finance is close to losing its license to operate, I say that to recognize that we must actually use our skills to try to do good. Finance skills are really important. Finance skills can actually help drive the economy in a very positive way. We should think about how to be positive as opposed to buy back shares, trade derivatives that make no sense, et cetera, et cetera.
In that regard, at the time, David's jotting in my mind that New Philanthropy Capital, the guy whose idea it was, actually suggested it should be a new division of Goldman Sachs at the time. And some of us had that discussion.
And I think my point is it has to go a step further. I work on global issues that don't have money to spend even.
Not enough money for this in global issues. Yeah. David, if you got a call from Tokyo, you saw the phone with a Tokyo code and you're like, oh my God, it's the Vision Fund, what would you do?
Not a chance. Not a chance. And actually, I wouldn't invest in the Vision Fund either. I don't think that they will ultimately have the long-term significant success that they might aspire to. And Saudi Arabia's capital, by the way, is debt capital as opposed to equity capital. It's structurally not what everybody thinks it is.
I'm trying hard to stick to my role as chair. I have some views on this topic. Jaina.
I just wanted to pick up this point from the lady from PwC around how condescending we've been to the country, if that's the right way of putting it. It's really interesting. I have a great friend in the city, a senior woman in the city who, she and I both voted Remain in the referendum, and I have got myself absolutely to a place of wanting to understand the fracture that created the outcome. And I bumped into her at an airport just this week, and she said to me, we have to educate everybody still as to why they're wrong. And it really shocked me. I was properly shocked. And what it reminded me of is that, we talk about the attainment gap, and it's funny, David, when you trotted out, we don't know the difference between a hedge fund, a PE firm, and whatever else. I mean, I reckon I was 50 before I did. That's not very long ago. But, right? And the really interesting thing is that, I came from a very working class background. Everything I've done sort of by accident. And a guy called Dave Dyer, who's been my CFO for 20 odd years, he came also from a very poor background, from Liverpool as it happens. And we both agreed, as we were running Virgin Money, that the really interesting thing for us is we'd never felt excluded from the world of hedge funds, PE firms, or investment banks. We just had literally no idea they even existed. So from our education, we wouldn't have even known that we could do some of the stuff that some of you guys have done. And I think that's still the case. You know, what is this peculiar thing that people tend to do down in the City of London? I can see quite a few people nodding around the room. And I think we have to break down that ridiculous mysticism around what all of this is for and how it works. Because for me, I had a brilliant mentor through the financial crisis. Jim and others will know him. It was Sir Brian Pittman, who used to be the CEO and the chairman in the end of Lloyds Bank. And he said to me, Jane Ann, the reason that we have a financial crisis is that no CEO knows what a CDO is. And it was so true, and I've always promised myself, actually I wasn't clever enough before, but I've promised myself after, that we should only ever do in finance and the rest of the world what we understand. And I think there's so much mysticism around everything that, you know, I think there's lots of us in the City of London that don't understand everything that we do and that goes on, and we have to make it understandable and simpler. And, you know, one of the things I know that central banks are concerned about around the world at the moment, particularly in America, is the re-emergence of some of the instruments of the past, and particularly leveraged finance. And if we go back to that place and we end up again with a crisis because people are complicating things in order to make money rather than to do good, then we have not learnt the lessons of the financial crisis. And we have to stand up for simplicity, understanding, and that will close the attainment gap, I think, and start to unite people again, in my view.
Michelle, perhaps on any of this, but in particular the question from the chap from LSE about, do we only do impact where we can find it easy to measure it?
Yeah. Am I allowed to respond to this one first, though, Jim? Because I was wondering as I came here whether I could get away with talking about what I'm now going to talk about, which is, so we've talked about inclusive growth and inclusive markets and sustainable markets too. So one thing I'm really excited about at the moment is this idea that actually, if you look at who owns a big portion of those markets, it's actually all of us, and it's all of us that have pension funds. And so one thing that's getting me quite excited at the moment is this question of, well, you know, a lot of people in this country anyway and around the world have got pension funds. They don't even, I think, they're not even aware of kind of where those pension funds are invested. And yet they control, I haven't found the percentage, but a substantial proportion of the world's markets because they are the owners of those, you know, indirectly. And I think that the financial sector has had quite a strong motivation to keep this mysticism because, and you'll see it, anyone who deals with private banks, or even when you go and you do ask your IFA, where is my pension fund? There is a tendency to sort of say it's all okay because I'm managing it for you and I'll make it simple for you. So my idea is, what if we could create pensions with purpose? And what if we could maybe root them in the SDGs? That hasn't come up as an issue, and it has earlier today, I know, but the SDGs give a lexicon for how we could be putting money into things that benefit people and planet. And what if we could get the word out there using this wonderful tool of technology and social media that, hey, do you realize that your pension fund might be invested in some things that you really don't like? And do you realize that you could actually, especially if you've got an employee pension fund, you could write to your employer and say, I want you to offer me a social pension. And it isn't something that I've just made up from my mind. In France, they do exist, the Fonds Solidaire.
I think, David, in the States, some pension funds are pretty advanced down this path, right?
Yes, and so is France.
France has the Fonds Solidaire. Australia, we're seeing that they're not exactly pension funds, but superannuation schemes are starting to develop and to really make a point. And my point is, not everybody thinks that the difference between private equity and hedge funds and risk return is really interesting. We might.
Really?
Not everybody thinks that. That's the brutal reality.
Really?
But they might really actually be interested in this question of, is my money doing good for the planet, or is it not? And that might get them interested in their pension funds. And actually, I think that's quite important, because that's a way for people to feel included in this global market, rather than what so many people feel now, which is that it's going on there, it's globalized, and it's not benefiting us, and there's nothing that we can do about it. So I think that could be an empowering thing. I don't see what you're saying yet. it is a danger because impact measurement is very challenging, and so it's a danger that you don't want to invest in something because it's going to look hard. It's going to be hard for you to show the beautiful graphs of how your investment has created a positive impact. At the moment, actually, though, in impact investing, I think we're rather more focused on intentionality, and it's led by those that really want to place their capital in impactful places. I don't see that yet, although I do recognize the possibility of that risk. And I think the risk becomes greater as we get non-impact specialists raising impact funds. We've got a whole new dimension around impact integrity now, because it isn't all people like me who get up every day wanting to be impactful with my money. It is teams that might look like me, but they're sitting in larger financial institutions, and there may be that there's a big issue around integrity of impact measurement that is rising.
I cannot believe it, but we're actually up with our time. So there's so many things that I didn't even have a chance to raise to you. This is the future, in my view, guys, and thank you to the three of you for sharing your time. As those of you active in Chatham House, my fellow council members here and others know, I am passionate about Chatham House being more at the forefront of helping take us more down this path and to become more of the norm. And so thank you for all your pioneering efforts from many years ago in this space, and for helping educate somebody like me and spending time with us. So thank you very much.
Thank you. Thank you.